basis points. We've just reached a nice round number. Thank you very much, Gilt Market. But it is that fear over hot inflation and what that means for Andrew Bailey and crew. He had said in January there are signs that inflation is starting to turn a corner. Perhaps he spoke too soon. It's also being reflected in a stronger pound. Euro versus the pound is the cross I'm looking at the moment. Euro falls by 0.3% versus the pound. Sterling had been weaker versus the dollar, again, as we win over to havens, but that is starting to change. The cable rate is stronger in general at the moment. Part of the way that we're also playing these concerns about the economy, about growth, sticky inflation, has been a poor trade in the commodity space. Certainly a stronger dollar doesn't really help too much, but copper, that's down about 0.6%. We've seen all the metals fall today. Iron ore had a tough day too. China continued to have this verbiage about cracking down on speculation in the market. That kind of bled through to the overall metals trade, but things like oil, that's having a tough go at it as well today, Alex.
Yeah, despite some really positive inventory numbers, and I say positive, supportive for the price, I mean. Okay, here in the U.S., you got the S&P up about S&P off 0.1%. NASDAQ 100, though, getting hit the hardest, down 0.6%. A lot of that, as you know, is a Tesla, it's Rivian, it's Lucid, it's that kind of story as Tesla lowers its prices on its cars. But it's also other parts of tech, and this is where CDW comes in. It's an IT services company. It's the worst performing stock within the S&P, down by about 13.5%. They see their customers much more cautious, and it happened really quickly. Like in the last 3 weeks, that has really picked up steam. No surprise, because that's kind of around the banking crisis, but still, that insight quite interesting. Ally Financial, here's a shocker. That stock is actually up by over 2.5%, but I thought the read-through to the consumer was, and the auto market was also interesting. They're taking a look at mounting consumer defaults over car loans, and they're putting aside more money and more provisions for that. So definitely watching that space, and it also kind of relates to the Tesla theme. Is the demand just not there? Now the 2-year yield up a whopping 6 basis points, but I gotta say I'm gonna blame Danny for that, because I think the whole bond market is gonna be selling off in Europe and the US in response to that UK inflation, and that front end just getting hit the hardest, Danny.
Yeah, look, we've unfortunately learned over the past year or so that the UK bond market can do pretty wild things, and those wild things have global ramifications. This is a global bond market. Alex, I wanted to show you exactly what CPI looks like in the UK. It's the white line I have on my chart. Europe is in the blue, US is in the yellow. Now, since COVID and this big pickup we've seen globally in inflation, it really has been the UK. It's the second highest inflation reading in the G10 space. It's at 10.1%. That is the reading we got this number. The expectation was still high. It was 9.8%, but now we have the psychological still double-digit number to contend with. Alex, part of the issue is that the highest thing in here, one of the biggest gainers in inflation, was food. Some 18% is where prices jumped in the last reading. Is that really something that can be solved with higher rates? Is that really a demand problem? Because, hey, people are always going to want to eat. So just what exactly can Andrew Bailey do to get UK inflation down?
Yeah, it's not even that. It's also the surprise that it happened like that. Berenberg senior economist Callum Pickering joined Bloomberg Television to talk about that surprisingly sticky inflation and then what the BOE is going to be thinking about it.
The Bank of England will be, relative to its February estimate, surprised by what Q1 inflation has done. No question, and therefore that supports the hike again in May. But the balance of demand and supply is pointing towards disinflation over the course of this year. You have big energy base effects to wash out. Monetary policy is not by now tight. Fiscal policy is by now tight. Producer prices have turned down a lot.
So all of this brings us to our question of the day. Does UK inflation 10.1%, does it push the BOE to 5%? Is that where rates will peak, or does it go perhaps even higher? Joining us now to help answer that question is Christine Aquino, managing editor of Bloomberg Markets, and MLive editor Van Ram. So Ben, what say you, 5% BOE?
5%, possibly even more than that, even though the economy is kind of feeling the shocks of the slowdown that we've long touted to have had. But, you know, if you look at the 5-year real rate in the UK, it's just 7 basis points. That needs to push up to 100 basis points for the BOE's tightening to have any meaningful effect on inflation. Clearly, what we saw this morning is not enough, and the BOE has acted too late, and now too late and too emphatically, and they need to go higher from here.
Yikes. 5 or more. Okay, Christine, talk to me about a 5 or more for the markets. How does that re-rate?
Yeah, that's going to be interesting, Alex. I mean, what Danny was alluding to, though, is a big question when it comes to getting actual inflation under control. Because, again, what we're seeing is signs of supply-driven inflation rather than demand-driven inflation. And so the question really is, what is the 5% rate going to do to bring that down? Probably not a lot. When it comes to markets, I think it's going to be a very interesting journey for the pound in particular. I mean, today we saw kind of a microcosm of the confusion over whether this is good news or bad news for the pound. We've seen that whipsaw a lot today. I mean, on the one hand, higher rates does mean positive things for the pound. It makes it more appealing to investors internationally. But then there's also the danger that higher rates leads to a buckling consumer. And that has been, up to this point in time, a big driver of UK resilience. But if that story will start to crumble, obviously that's going to mean bad things for the pound down the road.
Yeah, it was a story we talked about a lot at the start of this rate hiking cycle, the sensitivity of UK consumers because of floating rate mortgages. Is that still true, that there's a limit to what Andrew Bailey can do just because of how directly it hits consumers?
Absolutely, Danny. I mean, that is one of the danger zones that the Bank of England was watching out for when it comes to the impact of higher rates. And we haven't even seen that come through to fruition. I think the bulk of those mortgages that are due to refinance, that's not going to come until September time. And so the second half of 2023 going to be particularly challenging for the UK on a number of fronts, especially if we don't see that impact of inflation on inflation from rate hikes potentially next month and maybe even in June from Bank of England.
So Ben, if we go to 5 or above, how is that going to help like my price of beans? Like I understand the idea, right? Okay, so things are going to go up, so I'm going to not spend on other stuff like clothes, and that's going to help me buy the food. But in theory, are we just past that now? Does this have to be a government thing?
Well, I think that they've got to clamp down on second round demand effects, and that's where the BOE's tightening is going to help. Yes, it would have helped a lot. It would have helped a lot. They've been emphatical in their rate increases. For instance, the first 50 basis point rate increase from the Bank of England came only in August last year, by which time inflation was already in double digits. Now they are having to play catch up, and that requires shock and awe.
How much of this can you extrapolate to other G10 nations with sticky UK inflation and the need to keep hiking?
Well, I think that the ECB and the Fed are in much better situations. We have seen the ECB's Eurozone inflation rate come below 7% and around 5% in the US. So the Fed has seen that its tightening has so far delivered 400 basis points of contraction in inflation. We haven't seen that in the UK, and definitely there's a lot more response in the EU as well. So I think that the Fed and the ECB are much better placed than the BOE.
That's just so interesting because I feel like that conversation has rapidly changed, like just in the last few weeks, Christine. I feel like it was, the ECB is going to be the hawkish one, the BOE is kind of done, and then the Fed is one more and done. And I'm just wondering how unprepared positioning is for a situation where that's just flipped on its head.
Yeah, I mean, that is the question, isn't it, Alex? And I think even just the price action today, where we're seeing the sudden adjustment to expect more from the Bank of England, just shows you how markets have really been unprepared. I mean, part of that, of course, is, I suppose, still some in the market holding on to this idea of a soft landing or a no landing scenario. But I think part of that is also because of the guidance that markets have received from the Bank of England itself. I mean, you mentioned earlier, and I think Danny has as well, that what we've really heard from Andrew Bailey and his colleagues over the last couple of months is that they are nearing the end of their rate hiking cycle. And time again, they've been surprised by an upside shock to inflation that's staying in the double digits. And I think that's kind of just put them in a difficult position now.
Yeah, and I guess, is it maybe a cautionary tale for other central bankers who are also talking about the end of their cycle? Really interesting. Thank you both so much for joining. That is Ben Ram and Christine Aquino. Now, coming up, we're going to get more insight on our question of the day. Does UK inflation push the BOE to 5%? Kieran Ganesh, multi-asset strategist at UBS, is going to join us next. This is Bloomberg.
if these central banks keep pushing against this sticky services inflation to get it back down to 2%, then something else will break. And if that's the case, then we are likely to see more safe haven demand for the dollar too. So I don't really believe that the dollar can really weaken significantly. Certainly, I think it's going to be choppy. There's going to be bouts when risk appetite appears better. But I think we're in for perhaps a rocky ride still for the rest of this year.
Jane Foley there, Rabobank head of FX strategy, talking about dollar strength earlier today. Dollar strength was so much at one point it was exceeding sterling. It was stronger versus the pound despite hot UK inflation. That has turned around though. Cable is up about 0.1%. And all of that gets us to our question of the day and what's fueling a stronger pound. Does the UK inflation figure 10.1% push the BOE to 5%? Let's bring in Kieran Ganesh, multi-asset strategist at UBS. Kieran, what do you think? 5% terminal rate for the BOE?
Well, I think the short answer is no. I don't think it should be surprising that UK inflation is higher than other places. Remember, the Bank of England was quite late in terms of getting aggressive in its rate hiking cycle. And the UK also has a very curious thing with the way it sets energy prices, which means that it's a bit more lumpy than you see in other regions. So inflation is too high in the UK. The Bank of England will have to hike more. But by the time they get towards that 5% level, we think that inflation will be substantially lower. And then they'll be entering more of that wait and see mode that perhaps the Fed is going to be entering a little bit sooner.
So what's higher? 5% more?
Well, 25 basis points at the next meeting, I think, is almost certain. I think now the question is, what do they do after that? The bar for further rate increases has clearly dropped because we've seen this very elevated inflation print. But we think that once they get above 4.5%, then the chances are that they'll start to slow. So we're looking for them to stop in that 4.5 to 5% range.
Does that mean you maybe wouldn't want to participate in some of the sell-off we've seen in the gilt market?
Yeah, so I think in the bond markets, we're seeing them as generally attractive relative to equities right now because, of course, those should rally quite substantially if we do see a slowdown either in inflation or in growth. So we like bond markets quite generally. And where the opportunity we think is actually in positioning in the currency relative to the US dollar, because a trend we are seeing opening up is this idea that the Fed is probably going to be pausing or even cutting rates sooner than other central banks.
Karen, to that point, if we wind up getting another 25 basis point hike and then nothing more from the BOE, the hurdle to cut, I would think, is extraordinarily high, which would go to support your thesis a bit, yes?
Yeah, I think that's right. I think we'd have to assume that the European central banks, including the ECB and the Bank of England, are more likely to hold rates high for longer, whereas with the Fed, where you're perhaps more likely to enter perhaps even a recession later this year, then they could be looking at cutting sooner. So that positioning of being longer in the European currencies and shorter in the US dollar, we think makes sense at this time.
To the point of liking bonds and sort of the trade, if it is, we are in an environment where things need to be cut, there's a lot of sentiment out there that agrees with you. Bank of America's latest fund manager survey had a record number of folks saying they want to be short equities versus bonds, or allocation away from equities and into bonds. But equities continue to defy gravity. What do you make of that?
Well, maybe people are answering surveys in a certain way and doing something different with their with the green button. I think we're seeing clearly a lot of strength in equities, and we think at this time they're basically pricing in a soft landing. We don't normally see US equities trading above 18 times PE unless we're seeing sort of double-digit earnings growth expectations or very low bond yields. So we think it is something of an outlier at the moment. So we're recommending that investors diversify away from US equities, either towards other equity markets like an EM, which is cheaper and maybe exposed to other cycles, or towards some of that high-quality fixed income, which we think is a good portfolio hedge right now.
Well, if the Fed's going to be the first central bank to cut, though, why not own U.S. equities?
Well, I think the appeal is clearly if you see the Fed cutting, then is it going to be good for some of those growth stocks, those tech names? But when you look at the valuations that they're trading at now, it's already pricing in quite a substantial cut in interest rates and earnings remaining robust. We're just not convinced that those valuations are fair, or that those earnings aren't going to see some negative surprises, as some of these businesses will prove to be more cyclical than I think is widely perceived.
Anywhere in the equity market you would buy? Anything you do like in American equity? I know you're looking more at EM, but what about sector specific?
Yeah, so within the US, I think things like utilities, things like industrials, which are actually a bit less cyclical than is commonly perceived. These are exposed to that spending from the Inflation Reduction Act, so we think that those are going to be both secular, strong winners over the coming years, as well as relatively defensive plays in the near term, as well as things like consumer staples, a classic defensive if we are going to enter a slowdown, if the consumer is running low on funds, and things like consumer staples should outperform the rest of the market.
Just going back to your point on the BOE and the ECB, that they're going to have to keep rates higher for longer versus the Fed. What kind of economic backdrop then, and what kind of inflation, or maybe a structurally higher inflation level, would that imply?
Yeah, well, so I think inflation is going to take time to get back below 3%. So we're looking for the end of the year to be inflation to be above 3 but lower. So we think that's the environment they're going to be facing. I think both the Bank of England and the ECB are not going to be comfortable cutting interest rates until inflation is really falling below 3% or declining quite quickly. So I think that's the kind of backdrop we're looking for. It's not that inflation needs to be very high for a long time, but just the bar for cutting rates, as you said, is quite high.
One of the arguments I saw from Bob Elliott on Twitter basically saying that, just looking at the UK specifically and arguing against this idea that they will need to cut at some point or they're not going to get all the way to 5, is just the BOE is in between right now. Just quickly here, I wonder what you make of that point, that they just haven't gone far enough. They've stalled the economy, but they haven't meaningfully slowed it down.
I think all of this is a function of the fact that they started getting aggressive quite late in the cycle. Remember, the BOE towards the end of last year was very conservative in terms of hiking interest rates and then has had to try and play catch up. And now they probably are in this situation where they're a little bit worried that maybe there's some things lurking in the economy, a bit like the Fed had, because they've had to hike interest rates so quickly. So they are a little bit stuck, but they'll just have to look at the incoming data and see how it evolves. As I said, I think a hike at the next meeting is highly likely. You know, in future meetings, I think they're going to be a bit more 50-50 as to whether they hike further, and it will really depend a lot on the incoming data.
Yeah, so, I mean, something was already lurking in the economy, right? It was UK pensions last time around. So, yeah, I guess that threat is ever real and present here in the UK. Kieran, thank you so much for joining us. That's Kieran Ganesh, UBS multi-asset strategist. Coming up, are you planning your summer holiday? Expect to see airfares in Europe rise by double digit. That is painful. We're going to hear from Ryanair CEO Michael O'Leary next. This is Bloomberg.
I think the positive is demand remains strong, and when we look at high oil prices, we've seen that before in the industry. Inflation, we've seen that before. If you've been around long enough, these are business as usual challenges, and it's clearly a much better environment than it was over the past 3 years.
In Europe, airlines are seeing increased demand for summer travel, but that also means that fares are on the rise. We talked to Ryanair CEO Michael O'Leary on the sidelines of the Bloomberg New Economy Gateway Europe.
Everybody's talking all winter long about energy crisis, consumer prices, rising interest rates, yet fundamentally we're dealing with an economy across Europe where there's full employment. People are receiving their wages at the end of every month and they're spending money. I mean, I think it feels almost like, I don't know what the 1920s were like after the Spanish flu or the First World War, but it's almost like people are determined to spend, and spend on travel in particular. I think that being locked up for 2 years with COVID has driven people back to the beaches of Europe. People have money and they are spending it. It is very difficult to get a restaurant reservation, a hotel or a flight in Europe. Now, Ryanair is still offering the lowest fares in every market in which we operate, which is right across Europe. But even we're seeing our fares. Last year we saw fares rise by 14-15%. We think this summer, and I'm on record as saying, I think it'll be we might get to double digit again, maybe 10% increase in airfares. But that'll be 2 years in a row of double digit airfare increases. So people are spending. I think we're nowhere near American level of airfares. Southwest's average fare last year was about $110. Our average fare last year was 44 euros. So it's still much cheaper to fly in Europe, but there's no doubt that it is getting a little bit more expensive, particularly as we move through the summer of 2023. But remember, this is the airline industry, and when things are going well, it means the next crisis is probably about 4 days away.
Man. 44 euros. That was Michael O'Leary, Ryanair CEO. But Danny, I understand it's a lower base, right? But nonetheless, that's very much an inflationary scenario. I mean, double-digit price increases again for airfares. That doesn't seem to me that's a peak in inflation.
No, it certainly doesn't, the fact that people are willing to pay that. But you know who did get a good deal, Alex? It's customers who found a deal on ANA. Have you read this story? One of the best read on the terminal.
Yes. Yes,
so good.
So basically, All Nippon Airways, ANA, they had a glitch. And basically, you could get like a business class seat for a couple $100 versus $10,000. Whether or not they honor the fare, I think is still a little bit up for grabs. But this was an amazing story. And if you got lucky on that, man, that's awesome.
I feel kind of bad saying this because he's not here to defend himself, but I totally feel like that's something Guy would have done. I feel like he's probably one of the people who found it. Alex, you one time told me the best time to look for tickets, it was midnight on some specific day of the year, so I feel like this is something he would have been on top of.
But the reason why people found out about it was because it was on social media. That's not a Guy thing. So I do not feel like Guy would have been able to take advantage of it, and that would have definitely bumped him out.
See, sadly, I neither check airline prices very frequently, and I'm not very social media literate, so I fall into neither of those buckets, Alex. Okay, well, let's take a look at where European markets are heading as we go to the close. I want to give you some of our last calls, some of the analyst changes. I want to start with travel. Now, TUI has fallen very significantly. It's trading at a low. This is a travel operator in Europe, so you'd think it'd be getting the same boost that Michael O'Leary is seeing. The issue, they've had some sort of structural internal issues, which means that their shares have been falling. But UBS says, look, where they're priced right now, and because the European traveler is still strong and wants to go places, they have upgraded it to neutral. Again, it's a valuation story. It is appealing. Looking at the retail space, Boohoo, speaking of young people things that I have missed out on, Boohoo gets a downgrade from Bank of America because they're getting more competition from Shein. I kind of know what this is, but again, I feel like this is one of these social media things I don't understand, but really cheap fast fashion clothes. They're expanding in Europe. That means more competition from them, so they downgraded their price target on Boohoo. Finally, wrapping things up with Renault. Alex, and you and I have been talking about this for much of the show, the fact that EV pricing is under pressure. So they are also getting a downgrade from Bank of America, saying that because of the pricing pressure, because of more competition, it's not the best time to be placed in Renault. So those shares are slightly weaker on the day, around 0.3%. And of course, we'll also get sales results from them next week. Coming up, it's the European close. This is Bloomberg. Stocks just finishing up the trading day here in Europe. We're just finishing it up, just a few seconds to go until the end of the trading day, and it is a down day for the Euro Stoxx 600. We're down 0.1% despite best efforts to stage a turnaround. You can see as we went through the day, we did start to climb. At one point we were posting gains, and then they slipped again to ever so slight losses. Now, most of the regions facing that phenomenon. Again, it's just this kind of tough environment and almost even split as well when it comes to the sectors that did better and those that did worse. The biggest decliner is the same thing that's declining in the U.S. at the moment. It is tech. If we're facing higher yields, both in the U.K. and continental Europe, it makes it tougher to argue that you should be buying duration stocks. Now, I'm just zooming in on the map here. This is some wonderful TV magic for you that you can see. Okay, we're back on this one. That's fine. Basically, a lot of red on the screen. Let's go ahead and look at some of the individual drivers of this equity market today. Now, I mentioned that tech was the worst performer. Here's what's part of it. ASML had earnings down 4%. They have a demand issue. Demand just wasn't strong enough. We did see some hints of this after TSMC said that they would be cutting CapEx. Of course, ASML does do business with them, so that's problematic. Of course, we're talking to Margie Patel of Allspring earlier in the show, and she did say she likes chip makers, that there will be a turnaround in the second half of this year. So that's part of the story of higher rates is issue for tech, but one company that was able to defy the inflation was Heineken. Despite the fact that volumes have been lower, they've been able to raise prices and people are willing to spend the money. So they had solid results, up nearly 4%, especially when it came to European beer drinkers. Finally, Renault, they were down a lot more, I will say, throughout the trading day. So this is part of the sector that had that recovery that I showed you in the intraday map. Renault ending down only 0.1%. They had a downgrade from Bank of America saying that there were pressure when it comes to EV competition. Tesla has cut its prices. We're going to speak more about that in just a moment. But Alex, quickly, let me show you what's coming up in the next 24 hours. Today, we're going to get L'Oreal sales. They, of course, just did that big acquisition of one of those skincare brands. So that won't be in the results, but will be interesting to see where they stand, if there are going to be more acquisitions on the way. Overnight, Rio Tinto sales and revenue, those will come out in the Australian trading session. We'll also get Deliveroo. How strong is the consumer, and are people still ordering meals to their home? And then finally, we're also going to be getting Volvo truck earnings, Alex.
All right, let's get to all of that then, Danny. European autos, we got Volvo truck earnings. We also get Renault sales and revenue as well. So joining us now is Valentine Moret, Alpha Value's equity research analyst for autos. Can we just go to Renault for a moment? What are you expecting in terms of sales and in terms of revenue from them, particularly in light of Tesla putting some pressure on EV makers to lower their pricing?
Yeah, actually. So the investors will be clearly focused on the comments around pricing tomorrow, as actually the Renault appears as one of the key competitors facing Tesla in terms of price range. We definitely believe that it can, in the short term, continue to weigh on the share price of Renault, but we still back our view that on the long term, Renault still remains a very interesting investment in terms of its structural improvement.
Valentine, Danny here. Great to speak with you today. Elon Musk hit back a bit about the media coverage over Tesla, saying that we're not trying to start a pricing war by slashing the cost of their cars, what consumers are going to pay. But is the net effect that other EV makers will have to bring down prices?
There is definitely a risk that that other car makers will have to decrease their prices, but there is also keep in mind that there is also a positive reading for this, as if we see raw materials going down, logistics going down, actually the price of making an EV car will be lower, and these companies will be able to lower the prices without impacting their operating leverage.
So if we move to Volvo trucks for a moment, what are you watching for when their earnings come out, and what kind of deliveries are you looking at?
Yeah. So, well, in terms of revenues and margins, we had also a sneak peek last week of the company. So everyone will be focused on the deliveries and most importantly on the order intake. So regarding the deliveries, we expect this to be very strong, as it is likely the trigger for the consensus beat on the operating margins. Now the focus, as I said, will be on demand, and especially that in the last quarters, Volvo has artificially limited its order intake to make it more manageable in terms of order book. So now we may be able to see an improvement there, but it can have two readings in our view. A positive one, that would be a better visibility for the company, and a more negative one, that it may be a sign of weakening demand.
Right, right. Speaking of demand, we had European car sales figures in Europe this morning. Registrations jumped 26%. That's the best since May 2021. Valentin, how much of that is demand versus just supply chains easing and the ability to actually sell more cars now?
Actually, this is very hard to say, especially because all these cars were already in the order books since a lot of months in the past, and that's why when automakers talked about their full year 23 outlook, maybe all were confident on the H1 results and H1 deliveries. So that's why all investors are focusing on H2 and how it will trend. So currently H2 can be seen through the order intake and demand. That's why everyone is watching that, and that's why everyone will be watching that on Renault tomorrow.
Well, we'll all certainly keep an eye out for that. Valentin, thank you so much for joining us. That's Valentin Moret, Equity Research Analyst on Autos and Parts at Alpha Value SAS. All right, let's take a look at where European stocks have settled as we head to the break. Interestingly enough, despite the fact that the overall headline index fell, there was quite the divide underneath the surface. The DAX was able to just barely eke out a gain. The CAC 40, that did pretty well, up 0.2%. It has been a story of resilience in the French market. There's also a really interesting Bloomberg story out about this idea that folks are moving to Paris over London. I mean, it's been a theme that's ongoing, but part of the fuel there has just been luxury. FTSE 100 down 0.1%. The inflation story is certainly not helping. Remember, these are big global companies in the FTSE 100. They do not benefit when sterling is stronger. So that is the dynamic that they're having to deal with. Now, coming up, speaking of which, the UK can't get rid of double-digit inflation, which means another interest rate hike is probably on the way. We're going to talk about the impact on fixed income, on what's happening on the front end of the curve. We're going to be speaking with Ella Hoja of Pictet Asset Management. This is Bloomberg.
Keeping you up to date with the news from around the world, here's the first word. I'm Angel Feliciano. Senior Russian officials have raised concerns that the war in Ukraine has left Moscow too reliant on Chinese technology. That's after the U.S. and EU sanctions shut off access to alternative suppliers. An internal Russian memo suggests that Moscow is concerned that Chinese technology may pose a risk to Russia's information security. Here in London, new home sales have fallen to the lowest in a decade. According to data compiled by Moyer London, sales plunged 39% in the first quarter from the previous year. That's the worst performance than during the COVID-19 pandemic. Meanwhile, the number of homes built in the first quarter was the lowest since 2014. Meanwhile, another strong inflation reading in the UK is raising the likelihood for more interest rate hikes at the Bank of England. Britain's Consumer Prices Index rose 10.1% in March from a year ago. That's driven by the strongest increase in food prices in more than 4 decades. The pound edged higher and UK government bonds sank after the report. Global news powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Angel Feliciano. This is Bloomberg. Danny?
Angel, thank you so much. Now let's continue the conversation on inflation with that red-hot UK 10.1% reading. Our question of the day today is, does UK inflation push the BOE to 5%? Or is 5% even enough? Let's bring in Ella Hoja, Senior Investment Manager at Pictet Asset Management. Ella, do you think the BOE is going to go to 5% now?
Well, the market's close to fully pricing that if we look at what we've projected for the next 6 months. So 3 months down the line, we get roughly 50 basis points in the curve. And then a little bit further on, it's about up to 5%-ish, I would say, approximately. So the market's saying yes. Now the question is that enough? Right? We were at this stage in the cycle where inflation was supposed to be coming down, and so we got a little glimpse of that early in the year. And we look at the numbers last month and this month, and we're kind of going in the wrong direction. So core is still about a percentage point higher than what the Bank of England has been envisaging. So that puts them in a really tough spot. So double-digit inflation, quite problematic for a central bank that we think has not really had a lot of credibility when it comes to markets.
So does that mean, Ella, that they're going to have to go farther or just hold for longer? That's a really different narrative for the BOE than I feel like we were talking about just like a month ago.
Right. I mean, I think they've been getting away with quite a lot from markets if you think about it, because if we go back to September when we had the big gilt wobble, there was a combination, we would say, of fiscal and monetary dynamics that was at play at that time, and so that should have given a little bit of a warning sign. So up to this point, the Bank of England is really relying on sort of this slowdown in the economy to bring inflation lower and all these base effects, but as we're seeing in the data, that's not happening. So to your question, should they be going higher? I think the question is more, can they go higher? Will they go higher? Because so far they've been moving very slowly. And even at this point, the market's still pricing 25 basis points for the next meeting. And yet we're still looking at double-digit inflation. So we're not convinced that they will go aggressively over and beyond 5%.
Is that because of credibility? Because Andrew Bailey has said things like we're starting to turn a corner. He's told markets not to price too much in. So kind of to, again, retain his credibility, can he move fast? Because he keeps saying that they're reaching the end.
Yeah, I'm not sure. I think if there's a big puzzle when it comes to central banks, I'm not sure what the Bank of England is thinking. We know the constraints they face, the same way we know the constraints that the ECB faces. But when you compare them to the Fed's been taking this far more seriously, at least once they realized that this was getting away from them, right? So we've not seen the same commitment from the Bank of England. Let's see what they say at the next meeting, because now they've got enough data points. If they put a firm message on it that they're going to get much more serious and more hawkish, perhaps they're turning a corner. But I would not stake my money on it.
Where would you stake your money? And I'm asking that as a way to talk about the curve. Like, where's the biggest re-rating going to be, and how do you trade it?
Well, I think for us, gilts are short versus treasuries, exactly for the dynamic of the central banks that I talked about. Not super excited by sterling. I mean, sterling's been having a good run over the last 6 weeks, mostly because the dollar has been coming down on expectations of cuts from the Fed. But would still say that the fundamental picture and backdrop for sterling is not a great one, given this central bank dynamic we're talking about. And on top of it all, I think when it comes to curves, we would say more of a steepener bias, so 2 standard 4/10 would stay steeper despite the sort of day move that we've seen today. And more broadly, probably more supportive of broad credit markets, we would say. Wherever you have inflationary dynamics, credit tends to perform a little bit better, but less so for rates and currencies.
Okay, so fading the move today to some degree. In the U.S., when it comes to yields there, we have seen a pickup when it's become more clear that some of the banking crisis effects have been dulled or we've moved past them. Mm-hmm. Do you think we moved past them, and do you think we moved past them to an extent where we could see 5% again on the 2-year yield?
Yes, I mean, possibly. It's very difficult to say. I don't think I would have a lot of conviction. But what I would say is the problems are likely to be in the pipeline in terms of wherever we've mispriced assets over this long period of time. So maybe it's less likely to be banks going forward, right? And certainly not the type of episode that we saw, because that's already been playing out, and it seems to be stable for now. But potentially in a lot of the asset classes that have, priced significantly away from fundamentals over the course of the last 12 plus years, and so that's where the problematic areas might be.
What is your favorite trade then? Like when you have sort of the West developing in a particular way, China though is reopening, how do you distinguish?
Well, so the way we're framing it is very much on the central bank credibility framework. So you want to, as a bond investor, you want to be long those markets in rates and in currencies where the central banks are getting much more serious about inflation, number one, and two, where real rates are positive or high, right? And that plays both in DM and EM. So this is really how we've been calibrating these views. And also, on top of this, markets where there's a high sensitivity in the economy to very high interest rates. And for example, Sweden is one of the places that comes to mind, right, because of the link between variable rate mortgages and central bank policy rates. So those are some of the examples where you have housing market sensitivity to rates that you probably want to own, because this is where you're likely to see more of a cyclical slowdown. So that would be probably the easiest way to say what our favorite position is.
So when it comes to credit spreads, I mean, they're nowhere near sort of recessionary levels. High yield crept up a little bit, got close to 500. It has come back down a bit. When you're looking at that, do you expect us, I guess there's also a recession call, but do you expect us to get to those more recessionary level of spreads?
Yes, we would say we're probably in that zone. Very difficult to time this to the T, but certainly potentially a second half of this year, maybe even later, but still certainly in that sort of dimension of the next 6 months or so. And this is the reason why we are playing it from a relative value perspective. First of all, the spread duration we hold in the funds is the lowest it's been in a very long time. But also, relatively speaking, we tend to favor European credit versus the US. Why? Because we're starting to see that mechanism play through in credit in the US, where it starts to tighten things. So yeah, so spreads haven't widened significantly. We will likely get more as we enter this periods of slower data and economy.
Ella, where are the safety trades you guys have right now?
Sorry, I missed the first part.
Where are the safety trades that you have right now?
Oh, safety trade. I mean, look, there's basically curve flatteners. They're probably the more kind of bearish risk trades, and this relative spread trade that I talked about. But generally liking a little bit of duration, so some interest rate sensitivity at the portfolio, not very high, because core inflation remains still sticky and the Fed is in hiking mode. But we're probably getting closer to that period where you can ramp up duration in bond portfolios. That also makes the dollar interesting, because the dollar is a defensive play, and you can get that famous dollar smile where you shift into a weaker growth dynamic in the US, but surprisingly enough, the dollar actually does well in that world. So we're looking to get longer dollars. We own some exposure here, but we're looking to get longer dollars into that. So that would be another defensive place.
I'm going to do a hard pivot here to Japan, because I was just thinking about safety trades, made me think about the yen, just let you know where my mind is going.
Yeah.
Do Japanese investors go back home? Do they flee treasuries and go back into JGBs?
Right. So from a hedge perspective, it's less attractive for them, the least attractive it's ever been, and so there's been some repatriation. We've seen that in the data. I think also the curve in Japan is one of the steepest you see in G10, and the investor community wants to be short of JGBs. We actually take a contrarian view to that. We think the very long end of JGBs is attractive, both for international and domestic investors, and so you could see some comeback to that effect. And the yen looks interesting. It's another defensive play, by the way. back to the question earlier. And so that is a large position that we are running. But at the same time, we pair it with this long in the very long end of the JGB curve.
Okay, that is interesting because, I mean, it's a trade that hasn't worked for some time now, right, considering what the BOJ is doing. So it's always wonderful to hear expectations of some normalcy coming back into the market. Ella, thank you so much for joining us today. Really appreciate it. That's Ella Hoya, Pictet Asset Management Senior Investment Manager. This is Bloomberg.
All right, stocks in the red, sure, but we are off the lows of the session. Got a lot of things going on. You got banks, you got tech, you got Tesla. Abigail's tracking the moves for us. Abigail?
Yeah, and all of that equals a pretty small decline at this point, Alex, down about 0.2% for the S&P 500. And it's interesting because you have the 2-year yield up 7 basis points. Typically, that could create some real volatility, but perhaps because we've already seen 426, it's kind of amazing that we've now backed up about 50 basis points since the heart of the bank turmoil. It's not affecting stocks all that much. And take a look at the VIX. It's not affecting volatility, this VIX index, at all with a clear 16 handle. In fact, let's take a look at the VIX because it's an interesting spot right here. Over the last 5 years, you can see back in 2018 to 2020 in this complacency range when it was currently always often at this level, it dipped down below this trend line a little bit, but then would shoot back higher over it. Then there's the pandemic spike. We basically have held it with these moves up toward 40, but not really above. And now we're dipping back below. The big question is, are we going to hang out below that level for a while, or are we going to go back up into the range? That's also the question for the S&P 500. And then very quickly, let's just take a look at a couple of the earnings movers. We have 2 clear winners, 2 clear laggards. Abbott Labs and Intuitive Surgical both put up good quarters. You can see really nice gains. These are among the best percentage gainers for the S&P 500. On the other side, CW Corp down 14%. The tech company, bad quarter and outlook. And Danaher, the industrial healthcare conglomerate type company, down 1%. Investors wanted more there, Danny. But this is beneath that very calm surface. Lots of movement.
Certainly. Abby, thank you very much. As Bloomberg's Abigail Doolittle there. All right, here's a look at what we're watching today. Let's get you set up for the rest of the day. Earnings after the bell, that's going to be Tesla, IBM, Zions Bancorp, Discover Financial, so both banking and tech in there for you. The Fed Beige Book, that's going to be at 2 p.m. New York time. Chicago Fed President Austin Goolsbee and New York Fed President John Williams will be speaking. How do they see the current credit environment of the U.S.? Do they want to keep hiking, Alex?
Yep, definitely looking forward to all of that. That wraps up for me and Danny. Coming up, Airbnb's co-founder will be joining Bloomberg Technology with Caroline Hyde. Definitely tune in for that. This is Bloomberg.
Day like Bloomberg. From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Caroline Hyde at Bloomberg's World Headquarters in New York. Ed, on assignment today, this is Bloomberg Technology. Today, we dive into Tesla's drop in car prices. Ahead of tonight's earnings report, it's how the cut in price is now making the Model Y nearly 30% cheaper this year. Plus, Netflix falls after missing subscriber growth estimates, but points to its password-sharing crackdown as a saving grace. And despite all the concerns over privacy, people are getting extremely personal with ChatGPT, as some turn to it for therapy. We discuss, but first let's check in on these markets and nervousness once again around some of the big earnings that come in a little bit drab. We look at Morgan Stanley, we're going to dig into the likes of Netflix in a moment, but we're also still thinking about what the Federal Reserve, what global central banks have to do to tackle inflation, still running hot in the UK. Nasdaq off by 0.1%, two-year yield, which reflects, of course, concerns about interest rate hikes, up almost 7 basis points on the day. We're looking at the VIX index, though, still well low. We're sub 17, so that anxiety not really playing into some of those fear indices, as they're known. Flick it on. Let's look at this fear index, because we are seeing some nervousness around riskier assets such as crypto after what has been a phenomenal run-up in Bitcoin. We are seeing it just off about 3.7% on the day. 29,000 is where we're at, so sub that 30,000 level. But I'm pleased to say, to dig into some of the micro moves on the day is Kriti Gupta. She's here for, well, talk us through some of those moves.
Yeah, well, I think the big one, Caroline, is going to be those Netflix shares.